This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au.
To buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.
Well, David Adams, thanks very much for jumping on Masters of the Market. Been really looking forward to this conversation. Maybe before we get into it, we could start with Reminiscent Capital and what your guys' investment philosophy is.
Yeah, great. No, thanks for having us. And very humbled by the name Masters of the Market. I prefer to view myself as a servant of the market. But we're a high conviction discretionary macro fund, sort of higher volatility than your sort of typical macro fund, a little bit more closer to what macro funds used to be, and focus very much on Asia. And we've partnered with Pinnacle Investments in Sydney, so they do all of our back office operations, distribution, all that sort of stuff. And we've been going since 2019.
And you've got an interesting background in market. It's a type of investment philosophy you don't see a lot of in Australia in particular, where most funds are really bottom-up focused. How did you come to that sort of learning as to that's how you want to invest? And maybe who were some of those people earlier on in your career which played a heavy influence on you?
Yeah, good question. So I came from sort of a maths and economics background and joined the sort of banking world kind of age 21 in London. And I was lucky enough, I joined a great desk, CSFP it was called, so Credit Suisse Financial Products. And it was a little bit, to plug the name, it was a bit reminiscent of what we're going through now. And it was essentially the very early days of derivatives, especially in the interest rate market, swaps, etc. So I joined as a sort of a market maker, running trading books. So by no means a trader, more of a risk manager. And what was interesting there was you had, a lot of, back then we haven't heard this word for a long time, but financial engineers. And so these were the very, very switched on, so PhD math, quant types, really kind of pushing the curve on pricing options and exotics, et cetera, et cetera. And it is somewhat reminiscent of what you think of blockchain now. You've got obviously cryptographers, et cetera, and blockchain experts. And it was porting that pricing kind of technology and evolution into sort of traditional financial markets. So I really loved that kind of technical side of things. It took me probably about 7 or 8 years as a book runner, risk manager, and then seeing different types of clients. And what was a real game changer for me was I moved to Sydney and I ended up sort of running Morgan Stanley fixed income. And what was great about that was you're a satellite office in the time zone. So when something big happens in the weekend, it was amazing. You'd have, because I was at Morgan Stanley, sort of well-known bank, you'd have some of the top names in the world would come through on a Sunday or a Monday morning. And they want to deploy, something's happened, they want to deploy risk. So they hit the New Zealand market, then they hit Aussie rates, then treasuries in Japan. And just watching different styles, big real money managers through to the Druckenmillers of the world, I just started to sort of cherry pick and learn and look at the different styles and get interested in macro. And it took a period of time sort of as a prop trader to then, proprietary trade, and then take the next step to move into a hedge fund. So sort of a little bit of luck, a little bit kind of the path I took. That I arrived at this.
And you mentioned Stanley Druckenmiller, who, I'm most interested in macro investing. Is just sort of the pin-up boy pin-up man for macro. He's just got the most incredible track record. Who were some of the other big names that you came across in those formative years whose work you really admired?
Yeah, good question. I mean, macro has really changed from what it used to be.
How so?
The evolution of it in many ways was, whether it was Paul Tudor Jones, etc., would have very much of a partnership with high net worth individuals. So someone who's made a lot of money in real estate or commerce that's used to taking very substantial risks, but is not versed in finance. And it might be along the lines of either an access trade, starting to push into an equity market in somewhere like India or Russia where no one's got access, and sort of shepherding them through that. And it used to be a lot more sort of collaborative in that obviously that PM would run the risk, and they might talk to the client and say, I'm doing this, do you want more of an allocation or do you want to get more involved, et cetera, et cetera. Very much of a partnership shepherded by the hedge fund manager, and outsized returns. And they could be in any market, totally unconstrained. And then that got very institutionalized into pension fund, more cash-like returns, et cetera, et cetera. And what you saw was, as a result, unfortunately, the returns came off. And when these managers, went back to their roots, whether it was, Bluecrest or Alan Howard with a single manager fund, the returns went back up again significantly because they weren't quite as constrained by the mandate. So if you look at, macro in its purest sense, in many ways, it's like a method of thought. It's applying, skewed risk implementation in what's hot. And which probably leads us into later in this segment, why so many of the macro managers are now moving to crypto. They would take all of their risk management, skewed implementation, and put that into something that's 100% vol asset that's been growing at 200% per annum.
So do you think what changed with macro in terms of the returns diminishing was all of a sudden macro investors that were prepared to ride out extended periods of low returns or even maybe negative returns for really outsized lumpy returns when the macroeconomic environment changed? Did they go from doing that to trying to get consistent returns each quarter because they'd been institutionalized? Was that the thing that really changed in that period, do you think?
That's sort of what the data tells us. And, I think it's a very dangerous word. A lot of allocators will be in trouble for saying this, but look, Sharpe ratio. And Sharpe ratio is a very dangerous word in some regards because to get very consistent, steady results, some people are fantastic and they can do that, of course. But quite often in this, low vol world, you're selling some sort of optional volatility. And then, of course, every so often, it might be every 3-4 years or less, you get a very big event, which happened, even more regularly than that. And those steady returns then suddenly have a 40, 50, 70% drawdown. So that institutionalization did hurt things. And you're starting to see a shift back whereby managers have closed their funds or they've handed back some money and drifting back to, kind of a more returns-focused benchmark.
And of all those great hedge fund managers, the sort of famous ones that you dealt with in your working years up until now, what are some of the attributes that you admire, or perhaps some that appear common among some of the great investors that you've dealt with?
Sure. I mean, I was very lucky that the desk I joined was essentially the founding partners of Reversion Howard, so we sat right next to the likes of Alan Howard, etc. And if I look at someone like him, and his team, number one, incredible work ethic. Cannot be outworked. Still to this day, I'll send him an email any time of day or night. He's back within 5 minutes. It's mind blowing. So number one. Number two is not cutting corners. And it was really, really instilled early on, not to cut corners. What do I mean by that? Not taking shortcuts such as, selling some sort of out of the money option to collect that premium because it's never going to go there. Or entering into a swaps exposure with a counterparty that's questionable, etc. Just getting rid of all of that downside risk. Very, very concentrated focus on downside risk. If I look at some of the best managers on the one hand, and then similarly those folks that are able to then flip. The sort of expression is when you're losing, to trade smaller and smaller and to manage your downside. And then these same folks, whether it's someone like an Alan or a Stanley Druckenmiller or the best out there, being able to go very, very large, very concentrated bets. Those folks are very rare. That really moves the needle.
And Alan Howard, it sounds like, has pivoted largely towards crypto investing these days, as of a lot of macro investors and sort of young unemployed kids as well. Talk to me how you're viewing that landscape, maybe why so many macro investors have pivoted, and what do you think they're seeing in that space, which is so exciting? Okay,
sure. So let's go big picture for a second. If you look through history, I've been reading a lot of economic history since I was a kid. Every 100 or so years, you get a complete regime shift in the reserve currency of the world, and we're kind of due. So if you look at what's happening, you've got this situation where you've got huge amounts of money printing going on. And you're getting a very, very, very diverse outcome in terms of, if you look at the top 1%, the top 10%, top 25%, getting richer and richer, richer, and the bottom decile and quartile is getting worse. Now, I have no issue with people doing well at all, but it's getting gratuitous in the sense that if you look at is this really the best we can come up with? So our idea of the current idea of support for the economy and for folks that are out of work and whatnot is, the Fed will credit digitally its treasury account. It'll buy government bonds, and the US banks will then have cash that they, in their wisdom, decide where that gets deployed. And look, they're hardworking men and women with good intentions, but they've got commercial rationale for what they do and don't do. And unfortunately, what's actually happening is it's very blunt. So if you look at small business lending, it's actually falling. It's not getting into the bloodstream of folks. And so, why is this an issue? This is an issue because, if you look at, it's not very, very well reported, but you've had the most unprecedented rise in murders in the US last year. If you look at folks that, their handouts have rolled off and whatnot, they don't own a property. They don't own crypto. They don't own a stock. And they are getting completely left behind.
A small amount of inequality I view as a really positive thing because it drives people to work harder and improve and create a better life for themselves. But the inequality we've got today is created not through talent or hard work, but by people that have already accumulated wealth or people who are close to the government spigot. And is that sort of the differentiating factor?
That's right. And so what you're seeing is, which, I think Raoul Pal has coined as being a bit of a life raft for folks. I've got friends that are, pilots and whatnot. They're completely out of work with no income, and this is not going well for them. And so, what you started to see little splinters of this, whether it was, the little guy in meme stocks, for example, trying to take a little bit of kind of revenge or get their piece of the pie. And, now with trading apps, etc., we've got whatever it is, I think 3 to 3.5 odd billion phones. You can download these trading apps. And so this, I'll round out back into your questions. I don't think we're about to lose the reserve status of the dollar. But what is happening is, with the amount of kind of money being printed and that divergence is, retail and the smaller folks are absolutely flocking to crypto. It moves. It's been rising, at a very substantial rate. In fact, Bitcoin, I think, over the past decades, the most appreciating asset on the planet. So they're flooding into the space. That's number one. And then, similar to, it's not just crypto, you're also seeing bit by bit, I think, a bit of a loss of trust in fiat paper money. And so real things are starting to really explode, whether it's energy, broad commodities just hit a high, kind of real things are going. So this is, big picture, this is one for those kind of naysayers. I'm watching with great interest, because history is sort of telling us, we've got all the backdrop in the world that, folks are starting to shift their kind of allocation of fiat money. And so, where could this go? Look, we're probably talking, you're already seeing super high net worth Swiss family offices and whatnot telling their top clients to have a bit more crypto or have some crypto. Sovereign wealth funds are doing it. So it's coming. And like I said, the retail folks, the growth rate of wallets and apps and phones is phenomenal. So where could this go? Over the next 3 years, I think it's a big inflow story, probably 3 to 5 years. And even if the world goes from a 1% allocation to a 3 to 5, it's a huge number. So that's kind of interesting.
And so you mentioned some of those fund managers and even yourself who've pivoted to being not a crypto native, if you like, but now interested in investing an allocation in the space. What about those investors who are really smart, who, they may just not like it, or the ones more that just aren't even willing to explore it? What do you think's holding them back?
Sure. So just to be clear, we don't do it. We don't trade crypto as of yet for the Reminiscent Asia Fund. Yeah. For some of the reasons we're about to describe here, and that is, if you look at more traditional finance or some of the investors out there, some valid arguments. Number one, Bitcoin's a pretty weird concept. Student of Satoshi and cryptography. You can understand why some folks would be, a bit skeptical. So that bit I understand. If we part Bitcoin as sort of digital gold, whatever people want to label it, and just look at the rest of the space, which is actually earning some revenue. In that regard, with some of those, especially where it's not a revenue-based platform, where it's maybe a NFT, et cetera, folks find it very, very hard to apply a discount cash flow model, and therefore, how do they even approach it? So I think it'll take some time before it becomes mainstream, which is a good thing. It means there's alpha and opportunity. And then, it's also a case of taking the plunge. They always, the expression I think on Twitter sphere is that, your first Bitcoin to buy, the hardest Bitcoin to buy is your first. And of course, almost everyone I know that's gotten involved is hooked. As I'm sure you've seen with maybe yourself.
That's until it crashes.
That's right.
What about, for me, it looks like, there's a lot of super smart investors who everyone's got an ego, and in a way, the younger retail investors have an advantage because their ego's not going to be smashed if they make an investment and it turns out to be stupid, because their identity is not built around being right in financial markets. Is there a little bit of that's what's happening? I see so many investors online who are so well versed in just criticizing ideas and desperate for people to view them as clever.
Yeah.
But they're not necessarily the ones that make much money, because they're not prepared to risk. They don't have a tolerance to risk looking stupid. And personally, the best investments I've made are ones when I'm talking about them to someone, I feel a little bit embarrassed talking about them because it sort of feels a little bit stupid, but that's why it's a non-consensus view, and there's the potential for asymmetry there. Do you think that's a part of it as well?
Yeah. So, if you look at, we've got this, I'm quite excited as an investor, just even watching and just observing from afar type of thing in some of the instances, but you've got this almost perfect cocktail of huge amounts of liquidity, huge amounts of kind of access and trading apps. So that's this kind of drift. And sort of what I'd sort of say to folks is, when you're looking at something like crypto, if you're looking at, say, FX volatility, it's about a 8 to 10% annualized vol. Equities somewhere around 15 to 20. Crypto somewhere in the 80 to 100 and 150% vol. So the first thing I would sort of say to folks is, if you're going to give someone a play with 100 grand, divide that by 5, because volatility adjusted, you're like for like. If your returns in a certain day, up or down in a given month, are a certain number, 50% for example, divide by 5. And it'll just put your whole frame of reference will calibrate correctly to the asset class. So that's probably one thing I would say. You asked a little bit more about the sort of ego element of, and I think that's a great point, because what I would say is, for someone like myself, 23 years in markets, various different markets, I've got involved in things when they were very early. But if I look at the crypto space, I would say you have to be incredibly humble, incredibly humble. There's a lot of potential pitfalls. So, for example, even with stable coins and the whole sphere. So, if you've got money on an exchange, you've got potentially regulatory risk. You've potentially got the exchange could go under. Now, it's a lot better than it was. And of course, you had theft before and hacking and things like that. But the internet was no different. If you probably a bit before your time, but when I first started working, we used to get email hacks all the time, and they don't happen anywhere near as much. So there's a lot to be very cautious with regard to some of those things we've described. And as I mentioned, if you look at, say, something like a Tether, I don't want to deride Tether, but it's not crystal clear how well that's backed. They have in their recent filings denied owning Evergrande's CP, but they do own some A2 CP. Let's talk about that for a minute. Some folks have done great in crypto, and they've built up, say, $500,000 in their account, in their Binance accounts, and they've just left it in the default, which is Tether. There's a reason they're getting paid these yields. And that is, there is a non-zero chance that you could have a problem with the backing of tokens, like stable coins like that. And it won't be slow. It'll be a waterfall where it goes from $1 to 10 cents to zero. And so if you look at your typical sort of macro folks and folks that have come through many, many years of very kind of tail event risks and pitfalls that are out there, if I look at some of the best people that I know from macro that have moved over to crypto, even they are incredibly humble, and they're drawing on all of the skills they've got with regard to risk management to make sure they avoid some of these pitfalls. Now, on the flip side, for some folks, ignorance is bliss. And when you've got something growing at 200% and they're limit long, they're going to have a great month, quarter, or year, by all means. But there is that inherent risk in there that they're probably not as aware of.
And what are some of the tokens that you're most interested in at the minute?
So it's a lot like the internet 20 plus years ago. I've got a book behind me I bought after the crash, and it's on page 1. It's got Amazon, or this delivery company. We're not sure they'll make it, and not too many promising prospects for them. It was $1.50 at the time, and obviously they've made it 8,000 times that or more. So I think one must be humble to this. I think the space is super interesting. Now, I don't think anybody knows for sure at this stage. So I think a sense,
and we're not giving tips to anyone.
No. I'm going to give you
actually explore which protocols you find most interesting.
Yeah, for sure. I'm going to give you my thoughts. But what I meant by that was I don't think anybody knows. I think it'll change a lot as we go through time. But in the short time frame, 3-6 months, a year or two, we can have probably a good handle on what some of those might be, which I'll mention in a minute. But I do think a little bit like the early days of the internet, like Netscape and whatnot. Some of those ended up going close to zero. And so, if I was to look now, I think very simply, if I was talking to someone not in finance, I'd say something along the lines of, if you had $100,000, you want to have the big two. So you want to have 60 odd percent of that, 65% in Bitcoin and Ethereum, with maybe of that split, 40% Bitcoin and sort of 60% Ethereum. And then you kind of got it in some ways. If those two go up a heck of a lot, there's a decent chance the alts do very well, if not a lot better. But you're going to kind of get the space sort of with those two. So I'd say something along the lines of, make sure you've got that. And then, I would split it out across some of the platforms and networks that look really interesting and are arguably better, probably better in some ways. So that'd be the likes of Solana and Algorand and Luna. And then you probably want to, think about sort of much like you would with an equity portfolio, have a little bit of exposure to some of the gaming space, whether it's things like Engine Coin, and there's obviously, all of the NFT space. I'll park NFTs for a second, but if you look at almost like in traditional markets, there's gaming, there's lending, all these different sectors, and have some of your altcoins where you've got a little bit of exposure to those sorts of things. I haven't made my mind up on it fully yet, but a very interesting token, which possibly is a Ponzi scheme. I wouldn't put it in the fund. I wouldn't necessarily put investors into it without huge disclaimers, but it is interesting. It's got my attention. That's Hex, whereby what they're trying to do is this sort of online CD, savings deposit type of setup, where essentially what happens is you go and you can stake the coin for a long period of time and get somewhere between 20 and 40%. I think it's been the highest performing token in history. So, big picture, what they're probably trying to do is own a decent, or have a decent amount of the world's savings pool and kind of distribute part of that back to the owners. But still, I have a lot of question marks on that one. It's a lot of bad press around it, but that's somewhat interesting.
And it feels like there's regulation coming down the pipe. I guess, do you feel the more decentralized the protocol is, the lower the risk of regulation? Do you feel that maybe there'll be some industries like, say, the play-to-earn gaming that'll be less at risk of regulation versus DeFi protocols? How are you maybe viewing that overarching theme of regulation in crypto, which feels like it's coming out of the US in one form or another?
Yeah, and it's going to be quite complicated, quite country specific. I don't have a lot of edge other than from what I'm observing, and that looks like different countries are still learning as they go. It looks like the US is actually starting to shift a little bit more pro in some regards, crypto. It's also interesting that, central banks have written papers on exploring it a lot more. It goes back to my very first comment that the central banks are starting to toy with the idea of, instead of this quite clunky sort of QE mechanism, we can just digitally credit people's accounts. Yeah, it's very clean and make sure people are actually getting the money. So there's a lot going on. What do if I was to guess sort of big picture, I think regulation will get its hands around all of it. You're seeing now that to open an account, you've got to do KYC and provide your address and all those sorts of things. I've spoken to some folks out there that are quite sort of advanced in the compliance space in crypto. And they've been the first to point out that despite slightly, sort of grey background to Bitcoin and the blockchain, it's actually very, very traceable. It's by definition, it's all on the blockchain. So as they get their kind of monitoring tools and that sort of stuff up the curve, I think regulation will come across most parts, as will taxation. I've spoken to some folks, and the way I'm conducting myself is just assume that everything is audited and looked at and treated as if it's all taxable, and then you have no downside. You're doing everything with with the spirit of kind of the taxation that may or may not come into place. I should think regulation will find its way around it over time.
And you see the US and China in what's been described as almost a Cold War, really. China recently banned Bitcoin for the umpteenth time, but this time it feels like the ban is more genuine than it has been in the past. Certainly a lot of the Chinese crypto exchanges are showing that to be the case. Do you think the game theory will eventually kick in where the US decide that this could be an advantage in that Cold War that they're currently facing with China, and actually choose to embrace it like they did the internet and enjoyed the fruits of embracing that innovation when they did?
Yeah, I think it's sort of probably a likely outcome. It's probably a likely outcome. And it feels a little bit like maybe because China's a huge holder of Bitcoin, feels a little bit like what they might be doing, because they can over there, is put the brakes on till they catch up, till they catch up and get their hands around taxation and regulation. And I wouldn't be surprised if they kind of reopen the plumbing at a future date. But I think they want to catch it. And in some ways, I don't blame them. I think it's probably quite onerous with 1 billion odd people and the rate that the wallets and the leverage was growing at for them to just dab the brakes. And the US will probably do well kind of getting ahead.
And talk to me about NFTs. They're all the rage. And it's been a fairly long mania now in terms of crypto. It's been going for quite a while and still really strong. Maybe a helicopter view for people that aren't familiar with non-fungible tokens, what they are. But then I'd really like to dive into why they're important going forward, if you believe they are.
Yeah, sure. So I'm not the world's expert, but what little I know is as follows: is that so it's essentially ownership. Whether it's ownership of a painting, or in a more practical sense, what's happening now is sort of digitalization of assets. So an example might be, you've got a young couple, they just can't afford the home that they want to live in Sydney or Melbourne, and it's just going to pass them by, but they want some exposure. So what can happen is, over time, like in the US, they sort of started this, it'll probably come here, is they can buy $200,000 worth of, say, for example, Melbourne property. And I presume the way that'll work is it'll be a basket of properties that get digitized, and there's partial ownership for people. So you might have a part share in 100 units, for example. So that's a good thing. I think there's benefit for everyone in something like that. And then on the more sort of racy side of things, the NFT market, whether it's a piece of art or something similar, is very much like a very, very racy commodity market, where it's the greater fool theory. What will someone pay? I think a stone or whatever was bought for $500,000, and if someone's going to pay more for it. Now that whole space, I don't invest in it. Would I play for fun and some bits and bobs? Yes. The people that are real experts in that space, they sort of know, what's going to have some demand. Whether it's kids that might want to have exposures to Pokemons that are digital. There's some real stuff there that if you've got some edge in your niche area, you could do very well. But I think with that, a little bit like tulips, is that that's been accelerated by huge wins they've had elsewhere in crypto. By lots and lots of money around, lots and lots of leverage around. So I'd just be a bit cautious for some of the more kind of inexperienced or new investors in the space, maybe not to plunge in with your whole portfolio on those ones early up. But look,
the Ether rocks are amazing, aren't they? I mean, for those that don't know, an Ether rock is a JPEG of a grey rock that could be drawn by an 8 to 10-year-old really, and there's about, I don't know if there's 100 rocks in slightly different shades of grey, and they're selling for millions of dollars US, which initially my gut reaction was, well, that's ridiculous. But then I heard, it was Dominic Frisby talk about, that art tells you an important story about what's happening in that particular time. And that's always been the case since the history of time. That's what art does. And if you look at what those Ether rocks are telling you, potentially it's just akin to the tulip mania, or potentially it's telling you that post GFC, when the Federal Reserve flooded the system with money instead of letting bad actors go bankrupt, which is happening in capitalism since capitalism started, they set off a chain of events where money's slowly becoming more and more trivialized, and we're currently in an era where people are moving to spend more of their life in the digital universe instead of their physical universe. And nothing really speaks to that as perfectly as a plain rock grey JPEG that's selling for millions of dollars. It encapsulates all that in one piece of artwork. And perhaps, whilst it's easy to just say this is stupid, it's like the tulip mania, which lasted for 6 months in Europe or whatever it did. If you actually stop and think about it, it can maybe tell an interesting story about what's currently happening before our very eyes.
I think that's spot on. And, when you get these big regime shifts, um, to exact point, I think there was a stat showing some of the, teenagers are spending more than half their waking hours in the virtual world.
Yeah.
If I look at my children, like how they think and how they operate, we can't relate to that. That's a very different world they've grown up in, and the way they think about the world and money. And, if one wanted to be quite optimistic about the space for a moment, it could be what probably is very, very early. And, I find it very, very interesting that the traditional gold and silver is not playing any of the role that it has done. Maybe if you're a young folk in India and China and traditional big buyers of those sorts of things, they're just probably not doing it anymore. It would have been interesting to go and gift someone a bar of gold, etc. Now they probably prefer a piece of Bitcoin or an NFT or whatever. Not to be underestimated. It could be huge kind of shifts, huge shifts happening.
Yeah, I was just going to ask, like being a macro investor, and I presume you spent a lot of time obviously trading commodities and currencies, but I think understanding the difference of what assets will mean revert versus what assets have the potential to experience exponential growth, and getting that difference right, because it's so material as an investor. And I don't know if a lot of investors spend a lot of time thinking about it. Is that something you spend much time thinking about in your investing?
Yeah, it's a good point to raise. Look, I should have started my career in equities, because to exactly that point, being a fixed income and a rates person, it's it's not necessary. You can make lots of return, obviously, but it's not unbounded. Rates are fairly bounded by the way the central banks put the front end. FX broadly tend to be mean reverting and bounded, whereas equities, of course, have got that asymmetric kind of upside, which is why you often see, if you've got a very, very equity kind of focused hedge fund, their returns can be phenomenal because they've got that asymmetry to the upside. If they happen to be on those really high growth stocks, it's really game changing over the long run. So back to the point on assets and kind of asymmetry. It is interesting if we continue to get what I've been sort of calling a fiat flea, which is people kind of moving out more and more out of paper money. It's really going to be interesting to see what happens to real things. And so we're seeing obviously crypto, we're seeing commodities, energy now. China just released something yesterday, say secure your energy at all costs. So it's going to be we've had lots of repeats of this through history. Napoleonic Wars, when there was a real kind of breakdown in kind of trust of sovereigns. Napoleon's advisor had him go and buy acres and acres and acres of forests because it was real and it had a 7% yield. Famously, Julian Robertson many years ago, big chunks in New Zealand he bought. It's a real thing for him. And so it would be interesting to watch over coming months and quarters what happens to real things. And if the fiat kind of flea deterioration gets a lot worse, quite where they go. And this is not a great thing for the little guy. Again, if you look at the US right now, their fuel's gone up, their gas has gone up, their energy's gone up, their 30-year mortgage rate's just gone up. It's kind of wiping out quite quickly all of the handouts. And the problem is, though, those don't have to mean revert in a hurry. So it could be quite
especially if ESG just keeps getting stronger and stronger. They don't have to mean revert ever, do they?
Well, that's right. I'm watching with great interest how that evolves.
So we'll finish up in a second, but I guess markets have been really strong. A lot of asset prices have gone up. Most investors, particularly, not so much in Venezuela or countries like that, but most Western investors, when they think of a crash, it's obviously asset prices dropping, and it's a deflationary crash. Talking about the flee from fiat, like you mentioned, do you feel there's a risk that the crash is not sort of a deflationary crash where prices of everything are dropping, but there is some probability that the crash looks like asset prices exploding and the damaging impact that has on society, and particularly the little guy that you mentioned?
That's a good point. And look, it's not paid to be too bearish, because in a world where there is so much liquidity, these dips get bought and the central banks come in. So I've given an analogy. In some ways, the more dangerous thing is actually if you're a hardworking conservative person and you live on a street with a bunch of other folks and you're just saving your money, retirees, they're not getting paid any income for it. And their neighbors might be long their properties, long equities, etc. And the divergence gets quite significant. Now, that's been okay up until now. But if you're starting to get, a runaway in prices of things that you need, your fuel, your energy, your food, then it becomes exactly right. It becomes a problem. Now, one thing that I'm paying attention to, and it's strange, but it's often led the world, is New Zealand. It's very often led the world in rate regime shifts. You wouldn't think of it, they have for a lot, in many cases. And what happened there was quite interesting. You had, last year, the electorate essentially turned around and said, house prices are a problem. They go up too quick and we can't afford to buy them. And the government essentially turned around and sort of amended the RBNZ's mandate somewhat to pay a lot more attention to house prices. And what does that mean? That means their propensity, they were the same as everyone else. They're like, we're not raising rates to 2024, then it got to 2023, then 2022, and now they're going to raise probably, this month. It's fully priced. And that's probably a good thing because it adjusts some of that stuff we were speaking about, the asset prices up here, the little guy not doing so well. Maybe if you dab the brakes with rates, you've got to be very careful how you do it because you don't want to engineer a crash by any means. But that's starting to spread. If you look at great economist Bill Evans, starting to make mention that the RBA mandate probably needs a look. I think it's a little bit out of date, a bit too high with the rest of the world. And what would that mean? That would mean that if they can bring down that inflation target, and I don't want to say this to offend any homeowners, it doesn't need to be by any means a crash or a significant correction, but you'll probably find the conversation around rate rises here, I think, will accelerate greatly. I think you'll find you'll get something next year, probably before mid next year, as opposed to what's being earmarked 2023, 2024, and that doesn't need to be, as I mentioned, anything that's terrible for equity markets or property markets, but just to probably dab the brakes a bit, allow people to kind of catch up. If they can engineer that, and the RBA tends to do a great job, that'd be a good thing. But if your first kind of opener, if these things aren't handled well around the world, and you get those runaway kind of prices, that's going to be a problem.
Beautiful, mate. That's as good a place as anywhere to finish. So I've loved it. Loved the chat. Thanks very much for the time, and hope to speak to you again sometime.
Thanks a lot for having me on. Appreciate it.
This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au. If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.